I think the drivers of capex last year, which were, you said, power, steel, ferrous metals, global commodities, are not going to be the drivers of capex this year. This cycle is going to be, roads, railways, ports. The drivers will change because I think the composition will change in the sense that those sectors were very private sector driven, right? I mean, power was a big boom in private sector, capex in power, steel, all private sector. I think the composition is changing. Railways is clearly driven by the government. Roads also, the government is front loading it, leading the pack. So is in the port side. So I think that the drivers of the new capex cycle are going to change because the person driving is moving from the private sector to the government. So the government is not going, is going to be the new front face, so to speak, or the person who will take the first shot at getting the capex cycle going, and therefore the sectors will change.
Yeah, it's ironical. 3 years ago, India was great micro and very bad macro. Right now, it's great macro and very poor micro.
Yeah, it's true. It's true. I think, but that's, it's also interlinked to a certain extent. Also, I think what's happened in India, unfortunately, is that there was obviously in hindsight, an excess capex cycle, right? Over exuberance on the part of the corporate sector in many areas. And we are now paying the price for that in the sense that, this Credit Suisse House of Debt report, and that the top 20 corporates in India are very over leveraged. The chief economic advisor has talked about that as well. And the banking system is impaired also because of that. So we are to a certain extent paying the price for the exuberance and the excess in a capital cycle of 03 to 08. And the price of that is being paid now by the banks, which have funded a lot of that and now are stuck with NPAs, and with the corporates, many of them who have over-leveraged balance sheets because they obviously would have assumed that by now the commodity price would be X and it's half X, or they would assume that 2 projects would be already in operation by now and they haven't come on stream, stuff like that. So you're paying the price for the exuberance of the past.
The Nifty, or when I say Nifty, benchmark indices this year are down by about 10%. Can they go down by another 10%, or that would be a stretch?
No, it's possible. I think another 5 to 10%, I think is probable. In fact, I would say it's probably a reasonable chance, because I think that, because I think that's written in one of the articles that, I think the FII flow is going to be subdued this year. I think already FIs, I've been saying this for some time, are very overweight India. Partly that overweight is getting corrected because India is starting to underperform. So it's partly getting corrected because of that. Partly will get corrected by selling, and partly will get corrected by no new flows. As whatever new money comes, people rebalance and use the money to invest in other markets, and India will come down. So I think the FI flow will be subdued this year. And could the markets drop another 5-10%? Possible. I mean, 5% I think is likely, but 10% I don't know. And frankly, these are difficult to predict. But I do believe that for the short term, the upside is limited till the market participants get more comfort that they are seeing earnings recovery, which they're not seeing yet.
But from a valuation standpoint, do you think a 10% correction is warranted? Because according to most of the brokerages, Indian markets are trading at about 14-15 times 1 year forward. There is some degree of optimistic earning assumption as well, but 15-16 times is just a shade away the historical average.
That's true, but if you break that up, the problem, I think, so the bull argument is right. The bull argument is you're trading at 15-16 times and you're trading on below normal earnings, right? So therefore, it's actually, if you normalize profit margins back to not 7%, but back to say 5.5 or 6%, you're probably at 12-13 times, if not lower. So that's the bull argument, that why is you talking about valuation being so expensive? It's actually not expensive. I think the flip side of that is that if you disaggregate that, 15-16 times, you have about 200 companies which are trading at 35 times, which are good quality governance, good business models, high quality companies. That's the companies you would like to own. I mean, they're not trading at 15-16 times. I mean, you would name me one good quality company of any significant size where I can invest $50 million, which is trading at 15 times. I can't find one. So I think that number is a fallacy of composition. It's, you're combining averages, it looks there. What you really have is good quality companies trading at 25 times or 30 times or whatever, and a whole bunch of mediocre companies trading at 10 times. And therefore, combined comes to 15 times. So the problem people are finding, or at least we are finding, is that if you want to maintain quality in terms of the type of businesses you buy and the type of management teams you buy, the market is not cheap. Because that's how you do name me one company, good business, good management, good long-term growth record, which is trading at 15 times. It's either 30 times or it's 10 times.
So what do you do in this kind of a market?
Yeah,
what you want to buy is not cheap, what you don't want to buy is cheap.
Which is why I think the market will go through a period of consolidation where, I mean, two things will happen. One is you'll go through a period of consolidation, so earnings will catch up. So some of the good quality companies will become a little cheaper. Some of them will become cheaper. Somebody will sell, someone will have a redemption, something will happen. So that's one thing. Second is that you have to find the cusp where companies which are not intuitively obvious as having a great last 10-year track record or 20-year track record, something which is not obviously known as a high quality blue chip, but you think is a better company than the market gives it credit for, or you think has very good long-term prospects, that the economics of the business are changing, and therefore it is priced as a mediocre business, but you think actually it's either already is or going to become a good business. That is where what you have to do. I think as I said before, I don't think you can easily find today very well understood high quality businesses which are trading cheap. So you have to stretch harder. Either find businesses which are going to become great in your opinion, or which are misunderstood by the market.
Was that the logic behind buying into iShares in 2010, 2009? No one knew it, but right now it's really the classic blue chip name in the market.
Yeah, no, iShares, I mean, to be fair, I wish we could replicate that consistently. It's obviously, it happens once in a while that something of that type. I mean, did we have the insight that Enfield is a good business? Yes, we did have that insight. Did we have the insight that Enfield will sell 500,000 bikes next year? No. I mean, they were selling less than 50,000 bikes when we bought iShares, right? I mean, in fact, Enfield was losing money or just about breaking even at that stage. We obviously knew it was a great brand, and Siddharth, if you ever meet Siddharth, and I'm sure you've met him many times, he had great passion on Enfield. He was convinced that it's a genuinely, one of the great brands, historic brands in India or in the world in cycling. But obviously we didn't have the wisdom to expect them to go from 50,000 to 500,000. I cannot pretend to tell you that my models predicted it will go to 500,000. My motorcycle didn't. But that's a good example where when we bought iShares, it was not even being, I told you I think in the past, right, when we bought iShares, it was trading at less than the value of cash on its balance sheet. So it was really in that sense a very brain dead investment, because you were really buying nothing. You were just paying the cash on its balance sheet. But our logic that time was, and I think the market understood that much, that there is a long-term opportunity for someone to break the Leyland-Tata duopoly in trucks in India. That that time they had 95% market share. That over time, no industry do only two players. Most industries, only two players are not going to have 95% market share. New technology, the iShares Volvo tie-up would allow them to get hopefully near 10% market share. And we thought Enfield is a very interesting long-term option. We're not sure how good or big it could become. So you have to find something similar like that. Like there's some companies we looked at right now where like we talked about like SRF for example we talked about, right? I mean it's a company which has a very interesting custom chemical synthesis business inside a very old business. Right? If you look at SRF on the outside, they've got nylon tie cord, they've got packaging, they've got industrial laminates, and a whole bunch of more, I would say, non-growth or more mediocre businesses. And they've got this very interesting piece inside, which is custom chemical synthesis, which is like, they do, which is basically a technology company. So they are very technology focused on chemical processes, both, life science and agrochem. So I don't think the market, at least till recently, I mean, the stock has done very well last 2-3 years, so now maybe the market understands it. But I don't think the market fully understood that this is the real growth driver of the company going forward. This is where all the capex is going. The return ratios are high here. It's a high margin, high ROIC, high growth piece where they have a genuine competitive advantage. So you've got to find companies like that where the market has not figured this out yet.
Is there a problem with big pharma? Suddenly, at least I've realized that US FDA is going extremely slow on giving new approvals. There is a massive price erosion in the US generic market. So the pharma story was, prices will never come down, return on equity will always remain north of 30. That core thesis is now coming under pressure.
I think it's a cyclical problem in the sense that the FDA has got these new PDUFA guidelines by which they need to commit to much quicker timelines for approvals on a prospective basis. So going forward, if you're sitting 12 months from now, the FDA cycle approval time for new approval will come down to less than 18 months, from 4 years almost now, 3.5 years now. So there is a cyclical backlog problem, which is which you're right, which is the FDA has gone very slow in approving, and therefore all the large Indian pharma companies have product launch challenges. They're not able to launch as many products as they want, and because of that, you're stuck with an old basket in the US. You're trying to flog the old basket. There is pricing pressure, consolidation on the buyer side, etc. But I think the pharma story, long term is still interesting because there's still a lot of growth opportunity in the US itself as well as rest of the world. Also, I think longer term, the driver of success will be the ability to get into biogenetics and complex genetics, right? So I think pharma is now going through a stage where the complexity of the business is changing dramatically. You know, the type of trials needed to get approval for a complex injectable or of 505(b)(2), or the type of the risk that you have to take as a company to get these complex genetics, inhalers, transdermal patches, complex injectables approved are much higher. So I think the days of a mid-sized pharma company trying to say I will attack the US, US market head on, I think are slowly coming to an end because they will not have the scale to take the type of risk which will be required in terms of having production facilities, for these type of complex genetics, getting into biosimilars. The game is becoming a big boys game. So I think the big guys, the top 2-3 guys, will I think actually do very well over the next 3 to 4 years. There may be a period of consolidation now, as the FDA sorts out its approval issues, but they'll do very well. I think the people who will be challenged are the medium-sized pharma companies who want to attack the US. I don't think they have the balance sheet capacity to take the risk that they will need to do to become a genuine player in the US now.
Suddenly things are looking bad and unpredictable for mid-cap IT. There are a handful of mid-cap IT companies like a Mindtree or a Persistent where numbers are still looking strong and management visibility is decent. But rest of the IT or mid-cap IT pack is in a serious disarray.
Yeah, I think that's because the industry is again changing, right? In the sense that I think the question you asked on pharma, I think is equally relevant for IT in the sense that IT, you have the legacy businesses, apps development and maintenance, ERP implementation, testing to a certain extent. I think this business is fundamentally deflating. It's getting commoditized. You're using a lot more automation tools and techniques to further lower the cost of delivery of this type of business. The price points are going down. As someone told me, when you move an app onto the cloud, you can't go to your customer and if I needed 100 people to maintain it when it was on site, I need the same 100 guys to maintain if it's on the cloud. I mean, you're going on the cloud means it's supposed to be lower cost and quicker to implement.
Paradigm has changed.
Paradigm has changed. So all these guys are going through a situation where their legacy businesses, which is like 50-60% of businesses, are actually deflating because every time the price point is going down for an app development contract or maintenance contract. So you need to grow the new lines of business. Like in pharma, you had the complex genetics. In this, you've got the digital lines of business, right? The SMAC stack, which Persistent talks about and all the guys talk about. So again, you're going to have a situation where everyone will not make the cut. Some companies, obviously the TCS, Infosys, the big boys will do fine and they have enough investment and they have enough scale that they can make the investment, that they will do enough stuff required, that they will have the digital practices in place. But even they have a challenge because you've got core business deflating and you're growing the new businesses. So can you grow the new businesses more than quick enough to compensate for this? But the medium-sized guys have a problem that this is deflating and I'm not sure they've been able to make the investments required to build the competencies on the digital side.
Technology and experience
because enterprise digital transformation, everyone cannot do.
Right? So you own Mindtree and Persistent.
Yes.
You still own them?
Yes.
As of now, can they be part of a 3-year portfolio?
I think so. I mean, both are good companies, good management, long term. I don't want to get into buy sell, but I mean, we still own them.
Which is one large cap IT company you're fond of?
We like. I mean, if you're given a choice, forget a price, right? If you forget price, I would go with TCS any day. I think Chandra is absolutely outstanding as a CEO, very high energy, got a long period ahead of him. I think fully understands the trends which are changing. Has built a really phenomenal management team around him, very young, empowered, high energy people, and I think they've got the scale and size to make the transition required. So TCS is obviously expensive, so separate issue. But if you take out the price, I think they will clearly, I think, do very well over the next 3 to 5 years.
One call which has worked as a charm for you, my compliments to you again on that, is you avoided PSU banks completely and totally. Yes. And now we can see the cracks, we can see the fault lines. A stock like PNB in this year itself has fallen 33%. We don't know which way the NPL issues will move. And honestly, I don't think government has done a great job of managing NPLs. Is the PSU banking system in a serious disarray?
Yeah, I mean, you don't need me to say that. I think, I mean, if you look at the stock prices, look at the valuations, you read the, the pink papers in India, I think everyone is on the same page.
All the business channels.
Yeah, all the business channels as well. That, I think on the same page that there is a problem in the PSU banking system.
But that's not an opportunity.
It could be. It could be in the sense that, and I've said this before, that if the government were to bite the bullet and genuinely bring about governance reform in the PSU banks, and again, I don't mean, the PSU bank has good quality people. The issue is you need governance reform in terms of boards, compensation, incentive system, all the stuff the Nayak committee has talked about. If the government were to implement the Nayak committee in true, full and spirit, I think the PSU banks could be an opportunity. Absent that implementation of Nayak committee, I still
there is no evidence of that as of now.
At the moment, no.
So then what? Stick to private banks, which everybody loves, which everybody owns. Isn't that a crowded trade?
It is a crowded trade. It is a crowded trade, which is why we've now looking at some NBFCs. I don't want to get into the names, but we are looking at some NBFCs because in the NBFCs, our thesis on financial services is exactly the same. You said that the economy to grow will need significant amounts of credit. The PSU banking system will be unable to provide the credit because either they lack capital or they lack the willingness to take the risk to lend. Therefore, there is a huge opportunity for anyone who is well capitalized to capture incremental credit opportunities. That includes the private sector banks, that includes well-run NBFCs. They're different. The private sector banks will focus on retail and corporate and more urban India, and and the NBFC will be focused more on more harder to reach customer bases. But the opportunity for growth for both the private sector banks and NBFCs is very large and very sustainable because the public sector banks, at the way it looks today, will not be able to deliver credit growth of more than 8 to 10%.